Japan is entering a moment where the warning signs can no longer be brushed aside. What once appeared as manageable strain has now grown into a system-wide alarm. The country is perched on the edge of a profound economic downturn, and the vibrations from this instability are shaking every pillar of its financial architecture. In response, Tokyo announced an enormous rescue effort, roughly 17 trillion yen, an amount so large that it underscores just how dire the situation has become. Yet the announcement did little to steady markets. Bond yields surged to levels with no historical precedent, flashing clear danger as investors demanded higher compensation for holding Japanese debt. At the same time, the yen slid further, signaling fading confidence in the government's ability to keep the situation under control. And just when Japan needs calm the most, a series of external and internal challenges are converging. China is preparing retaliatory measures. Japan's tourism industry, one of its most dependable revenue streams, risks collapse. U.S. protectionist policies are squeezing Japanese factories. And across the Pacific, America is trapped in its own contradictions. Trillions in stimulus checks, runaway construction costs, and a central bank that can't raise rates without crushing growth or lower them without fueling inflation. These challenges are not isolated crises. They connect like gears in a single machine, each amplifying the pressure on the next. Decisions Japan makes now will not only determine its own direction, they will ripple across the global economy, affecting trade flows, currency markets, and investment strategies worldwide. Japan's newly announced stimulus package is being marketed as a bold attempt to stabilize an increasingly fragile economic landscape. The plan totals around $110 billion and is designed to revive a slowing economy and shield households from rising prices. But pouring such a huge sum into an economy already buried under one of the world's largest debt loads brings enormous risk. Markets reacted instantly. Yields on 20-year government bonds jumped toward 2.8%, a record that sent shockwaves through investor circles. In a country where debt exceeds 230% of GDP, this type of yield spike doesn't just reflect market discomfort, it reflects fear. Rising yields tell a simple story. Confidence is deteriorating. Investors are beginning to question whether Japan can continue borrowing at this scale without consequences. As they demand higher returns, the cost of government financing balloons. Higher financing costs weaken the yen even further, and a weaker yen raises import prices, which then intensifies inflation. All of this feeds back into the bond market, forcing yields higher still. It becomes a loop that strengthens itself every time it spins. Tokyo insists that this stimulus will support families dealing with soaring living expenses, while also accelerating Japan's push toward advanced technologies, AI development, semiconductor manufacturing, and next-generation industrial equipment. But investors are not convinced. For decades, Japan has launched ambitious spending programs with minimal long-term results. The economy remains sluggish. Productivity has barely moved. And the population continues to shrink, shrinking the labor force with it. Worse yet, Japan's economy contracted by nearly 2% in the third quarter of last year, the first drop after a streak of growth, hinting that external pressures are biting harder than expected. Global trade tensions are weighing heavily on Japanese exports, while the cost of imported goods continues to rise. The real threat isn't only the size of the stimulus, it's the speed at which pressure is building. Once yields start rising in a country this indebted, every future rescue plan becomes more expensive to implement. Borrowing costs surge. The currency slides. Investment slows. And suddenly, the economic tools meant to save the country become too costly to use. Adding to this economic turbulence is a gathering geopolitical storm. Japan's recent diplomatic posture regarding Taiwan has angered Beijing, and China is preparing to respond. For China, Taiwan is not a negotiable topic. Even the slightest hint of Japanese involvement reopens historical wounds and triggers strong nationalist reactions. Chinese state media, often a predictor of government policy, has begun hinting at potential punishment, sanctions, new tariffs, and targeted trade restrictions. China doesn't need sweeping measures to hurt Japan. Small disruptions could cause enormous pain. Japan's tourism industry, about 7% of its entire economy, relies heavily on Chinese visitors. Between January and September alone, over 7.5 million travelers came from mainland China, and including Hong Kong, the number climbs to more than 9 million. Hotels, airlines, luxury shops, restaurants, cosmetics brands, entire supply chains are built on Chinese spending. When Beijing issued a simple travel warning last year, the market reaction was immediate. Shares of Shiseido collapsed more than 10% in one day. Investors know how quickly a tourism slowdown can turn into a full-fledged boycott. China has used consumer pressure before, and Japan is extremely vulnerable to it. But tourism is only the tip of the iceberg. China wields even greater leverage deeper inside the supply chains that Japan desperately depends on. Japan's entire recovery plan rests on rebuilding its technological capability, particularly in semiconductors and electric vehicles. These are industries Japan believes can drive long-term growth and offset declining domestic demand and rising global competition. However, nearly every advanced technology Japan aims to manufacture requires resources that China dominates. Not partially, almost entirely. China controls close to 100% of global production of gallium and magnesium, metals essential for cutting-edge chips and lightweight components in EVs and high-performance electronics. China also controls most of the world's rare earth refining capacity, the step that turns mined minerals into usable industrial materials. Without these refined inputs, Japan cannot build the motors, sensors, magnets, and chips that form the foundation of its economic revival plan. China also controls roughly 70% of global magnet production, which is fundamental to EV motors and countless industrial machines. Graphite, the key ingredient in EV batteries, is also overwhelmingly supplied by China. The pattern repeats across nearly every strategic input Japan needs. Japan is now caught in a tightening web: rising debt costs, weakening currency, shrinking workforce, geopolitical exposure, reliance on Chinese supply chains, vulnerability to tourism shock, and growing trade pressure from the United States. These forces are converging faster than policymakers can respond. Japan now finds itself in a precarious situation, caught between its dependence on critical materials and its growing willingness to confront China on the diplomatic stage. It is challenging Beijing at the exact moment when it needs steady, low-cost access to the resources that keep its factories running. Any interruption, whether Beijing formally restricts exports, imposes narrow but targeted sanctions, or even encourages a slow-burning consumer boycott, would send an immediate shockwave through Japan's industrial network. Production expenses would surge, assembly lines would freeze, and the very sectors Tokyo hopes to revive through its massive 17 trillion yen stimulus would suddenly find themselves unable to operate anywhere near full capacity. All of this is unfolding while the global trade environment becomes increasingly hostile, especially with the United States, where Washington's tariff-heavy strategy is setting off its own chain reaction of economic distortions. The United States is now ensnared in a problem it engineered for itself, built around a single tool: tariffs. These levies were marketed as a pathway to restoring American manufacturing, rebuilding lost industrial capacity, and generating domestic jobs. In practice, they're doing the opposite. Rather than reducing expenses and fostering industrial resilience, they're driving production costs so high that manufacturing in the U.S. is becoming financially impossible. Aluminum illustrates the issue better than anything else. The world's largest aluminum supplier recently slapped a $2,000 per ton premium on shipments headed for the American Midwest, and bluntly announced that the U.S. market is fundamentally broken. The numbers back up their claim. Inventories are shrinking, supply is drying up, and prices are spiraling across the entire industry. This isn't a minor inconvenience. It's a direct threat to every major U.S. sector that relies on large-scale construction and advanced technology. Building an electric vehicle, expanding a data center network, or constructing a semiconductor fabrication plant, all essential for America's technological future, now costs vastly more than it did just 2 years ago. Because tariffs punish imported materials, companies are forced to buy domestically, where steel, copper, and aluminum prices are inflated far beyond global norms. With import duties on steel and copper exceeding 30%, many manufacturers simply cannot absorb the additional financial burden. Meanwhile, other nations are adapting. Canada, for example, has shifted a major portion of its aluminum exports toward Europe, where pricing remains relatively steady and demand is predictable. The result? U.S. aluminum prices have nearly doubled, while Europe remains largely insulated from the chaos. This divergence not only erodes America's competitiveness at home, It makes it nearly impossible for U.S. producers to compete abroad for global contracts. And this is happening at the worst possible moment. The United States is trying to lead the artificial intelligence transformation, a project that requires more than $1 trillion in new infrastructure, semiconductor fabrication plants, hyperscale data centers, high-performance computing facilities, and next-generation energy grids. Every one of these projects depends heavily on materials that tariffs have made prohibitively expensive. And the foundational system underneath all of this is already under strain. America faces a $3.7 trillion infrastructure funding deficit, including nearly $600 billion for modernizing energy systems, almost $700 billion for repairing roads, and another $170 billion to fix aging bridges. With these gaps, any effort to scale up manufacturing or build the facilities required for AI becomes dramatically more costly. Economists estimate that generating just $1 of economic output now requires roughly $2 of investment, an imbalance that current policies are only making worse. The harder the U.S. pushes to expand, the more the inflated input costs push back, tightening the financial vice. As if these structural problems weren't enough, Washington is preparing to add yet another layer of instability. A new proposal from President Trump would send $2,000 checks to American households, marketed as a tariff dividend. More than 100 million Americans are expected to receive these payments by mid-2026. But the price tag is staggering. Estimates suggest the plan could require anywhere from $300 billion to $600 billion in additional government borrowing, on top of the already historic national debt. Treasury Secretary Scott Bessent has attempted to link this plan to the administration's no tax on tips policy, but that does nothing to change the fiscal reality. An injection of hundreds of billions of dollars is guaranteed to hit the economy quickly. Most households will spend the money almost immediately, pushing demand higher across every major consumer category. Profits created along this expanded pipeline will eventually flow upward into assets, stocks, real estate, gold, raising prices even further. The timing turns this into a policy trap for the Federal Reserve. The Fed was already struggling to decide whether interest rates should be cut, and now it must factor in the arrival of as much as $600 billion in short-term liquidity. Cutting rates too soon risks igniting another inflation spike. But delaying rate cuts could choke off growth in sectors that depend heavily on borrowing, especially technology and data infrastructure. Markets are already signaling discomfort. The probability of no rate cut has jumped to 53%, clear evidence that traders believe the situation is becoming more uncertain. The recent government shutdown made the problem even worse by interrupting critical data flow, leaving the Fed with less clarity as it faces one of its most difficult decision periods in years. A massive stimulus, heightened inflation risk, and a fog of missing data have combined to put the entire U.S. financial system on edge. And these stresses are not isolated. They are now bleeding into each other. The challenges facing Japan, China, and the United States are no longer separate stories. They're merging into one broader crisis. Japan is straining under rising import costs and weakening global demand. China is expanding its economic leverage while preparing for potential retaliation. The United States is stuck in a tariff system that weakens the very industries it claims to defend. These forces are not abstract. They are shaping the next stage of a global economic storm, one that could reshape trade, growth, and geopolitical power for years. So the questions now are simple, but the solutions are anything but. Can Japan maintain stability without sinking deeper into debt? Will China escalate its economic pressure, and how aggressively? And can U.S. industry withstand the weight of its own protectionist policies? The world is watching, the margin for error is shrinking, and the consequences of any misstep are growing sharper by the day. What do you believe comes next? Share your thoughts below, and if this breakdown helped you understand the larger picture, hit the like button and subscribe, because this story is only beginning.